Hey everyone, welcome back to Bliss Insights, your go-to space for breaking down money matters without the headache. Let's talk about something we all deal with but rarely understand fully. Are you overpaying tax in the UK? If you're earning a salary, freelancing or running a business, this could be costing you hundreds, maybe thousands every year. So grab a drink, take a breath, and let's break this all down in a real, relatable way. Okay, so let's start simple. In the UK, we've got a system of income tax bands. Now, the first £12,570 you earn each year, that's your personal allowance, completely tax-free. Think of it as a breathing space before the taxman comes knocking. Now, for earnings between £12,571 and £50,270, you're in the basic rate tax band, and that's taxed at 20%. It's the rate most people pay on the biggest chunk of their income, but here's where it gets interesting. Anything you earn over £50,270, that's hit with the higher rate of 40% tax. And if you're lucky enough to earn over £150,000, well, that top slice gets taxed at a hefty 45%. Now let's keep it real. Most people watching this are probably focused on that 20 to 40% window, and here's what a lot of people miss. You don't pay 40% on your entire income once you cross that £50,270 line. It's only the bit above that threshold that gets taxed at the higher rate. But even a small raise, a bonus, or a bit of extra income can push part of your earnings into that next band. And that's where your take-home pay can start shrinking faster than expected. So understanding these thresholds is crucial. It's not just about how much you earn, but how much of your income falls into each tax band. Remember, knowledge is power when it comes to your money. We'll dive into some real-life examples in a moment, so you can see exactly how this works in practice. Right, let's ditch the theory for a moment and get down to brass tacks with some real-life examples. Imagine someone, let's call her Sarah, earning £25,000 a year. She's doing all right, right? Now, after taking off her tax-free personal allowance and applying the basic rate of 20%, Sarah pays about £2,486 in income tax. That leaves her with around £22,514 to actually live on. Not bad. Now, let's look at someone else. Let's call him David. David earns a respectable £52,000, double Sarah's salary, you might think, so he must be laughing all the way to the bank, right? Well, hold your horses, because David's income is above that £50,270 threshold. He's going to be paying a chunk of his earnings at the higher rate of 40%. In total, David ends up paying over £9,000 in income tax, leaving him with a take-home pay of roughly £42,000. Now, that's still a good income, but it's not double what Sarah takes home, even though his salary is. And that's the point I want to drive home. A higher salary doesn't always translate directly into a proportionally fatter wallet. The taxman has a habit of taking a bigger bite as you climb that income ladder. So before you start celebrating that promotion or pay rise, it's crucial to factor in how those extra pounds will be taxed. It's not just about the gross figure, but what you actually get to keep in your pocket. Now, don't despair. Just because the taxman takes his share doesn't mean you're powerless. This is where it gets interesting. There are perfectly legal and above-board ways to keep more of your hard-earned cash. First up, we've got pension contributions. Now, I know pensions might seem like something for later life, but they're a fantastic tool for reducing your taxable income right now. By putting money into a pension, you're essentially lowering the amount of your earnings that are subject to tax. Plus, you're saving for your future. It's a win-win. Next, let's talk about ISAs, or individual savings accounts. These are brilliant for growing your money tax-free. You can choose from a range of ISAs depending on your savings goals and watch your money flourish without the taxman taking a cut. Then we have salary sacrifice. This is where you agree with your employer to give up part of your salary in exchange for certain benefits. Think things like childcare vouchers, cycle-to-work schemes, or even gym memberships. The beauty of salary sacrifice is that you're essentially paying for these benefits with pre-tax income, which can reduce your tax and national insurance contributions. Another thing to consider is timing your income, expecting a bonus or a large payment. If you're close to that higher rate tax threshold, it might make sense to delay it until the new tax year, if possible. This could potentially keep you in a lower tax bracket and save you a bundle. These are just a few examples of the smart strategies you can use to keep more of your money. Remember, it's not about avoiding tax altogether. It's about being savvy and making the system work for you. Now, for those of you fortunate enough to be earning around the £50,000 mark, listen up. This is where things can get a little bit tricky. You see, once you cross that £50,270 threshold, every single pound you earn above that is taxed at 40%. And if you're on track to earn over £100,000, well, brace yourselves, because you start losing your personal allowance. That's right. That precious tax-free allowance starts to shrink, meaning you're effectively being taxed twice on some of your income. Ouch! So what can you do if you're teetering on the edge of these thresholds? Well, remember those smart strategies we talked about earlier? This is where they really come into play. Topping up your pension contributions can be a particularly effective way to reduce your taxable income and soften the blow of that higher rate tax band. Similarly, making charitable donations under gift aid can also be beneficial. Not only are you supporting a worthy cause, but you can also claim tax relief on your donations. And don't forget about your ISA allowances. Making the most of these tax-efficient savings accounts can help you shelter some of your earnings from the taxman's clutches. The key takeaway here is to be proactive. If you know you're approaching these higher income levels, don't bury your head in the sand. Take the time to understand the implications and explore the options available to you. Chapter 5. Before we wrap things up, I want to address a common misconception that I hear all the time: the difference between tax avoidance and tax evasion. Now, let's be crystal clear. Tax avoidance is not illegal. It's about being smart, planning ahead, and using the tools and allowances that the government makes available to you. Think of it as being tax efficient. Tax evasion, on the other hand, is a completely different ballgame. That's when you deliberately mislead HMRC, hide income, or falsify records to avoid paying your fair share. And trust me, that's a road you don't want to go down. The consequences of tax evasion can be severe, including hefty fines and even prison sentences. So let's not even go there. The bottom line is this: the UK tax system is complex, there's no doubt about it, but it's also designed in a way that rewards those who take the time to understand it by using legitimate strategies like pension contributions, ISAs, and salary sacrifice. You can keep more of your hard-earned money and achieve your financial goals faster. And that's not being shady, that's being financially savvy. Look, taxes aren't going anywhere. But what is within your control is how much you lose to them. So take some time this week to check your pay slip, review your income, and maybe even speak to a tax advisor. Your future self will thank you. Let me know in the comments if this was helpful. And tell me your biggest tax surprise. Don't forget to like, subscribe, and hit the bell so you never miss a money smart moment here on Bliss Insights. Catch you in the next video.